Good afternoon, everybody, and welcome to Live Market Analysis Macro Edition. That means we're going to look at the world of global finance. Could be global indices, could be bonds, could be foreign exchange, could be commodities, could be crypto. We're going to try and figure out how it all relates back to our portfolios. My name is Carl Capolingua. I'm the Market Analyst over here at ThinkMarkets Australia. It's a pleasure to be with you. The agenda for today is pretty simple. I'm going to do a little bit of a whip around the grounds, as I tend to do in these sessions, but then I'll open the floor up to your questions. So ask me about anything from anywhere in that world of finance, and I'll do my best to explain it to you, why it's important, and give you my best technical and fundamental analysis reader. Let us head over to the charts first and foremost, because I do believe a picture tells 1,000 words. And this is just such a great picture here of risk on sentiment. So what we're looking at here is really the most sensitive group of assets. If we could find a diverse group of assets that the NASDAQ Composite is, nearly 5,000 US companies doing all sorts of things. And that's why it's a great indication of what's going on globally, but also they tend to be longer duration. So this is really what's going on at the moment, this idea about long duration. What does that mean? It means their earnings tend to be further out in the future. They're early stage companies. They're early in their development. They're not like General Electric, a big, boring, old bellwether stock that you find in the Dow Jones Industrial Average, 30 big blue chip stocks. They can be weird and wonderful. Hey, there's also some big ones in there as well. But they tend to be longer duration, which means they tend to have higher debt levels. Higher debt levels means more sensitivity to interest rates. And the other thing is, the longer or the further out your earnings are through the discounting of future cash flows, that mechanism that investment analysts, all serious fund managers use to value a company, you are more punitively discounted the further out your earnings are. So the bottom line is, these are the most sensitive companies as a group to what's going on with interest rates. And it's all about interest rates at the moment, ladies and gentlemen, because we do have a once in, not just a generation, but a once in a couple of generation move up in interest rates, both in terms of the size of that move. So from pretty much zero in the US to now over 5%, and the speed. Just over a year that we've seen such a move. Hasn't happened for a very long time. So there are many traders out there that just haven't had to deal with what we're dealing with right now. And hey, what does a rapid and large sudden increase in interest rates look like for a stock market? Well, there you go. That's what it looks like. Right here is where, well, it's actually here. This is the day. Right here. This is the exact day. I kid you not. This is the exact day that Jerome Powell got up in his speech, acceptance speech of his second term as federal chairman of the Federal Reserve, and shuffled his papers. And literally in that speech, prior to that, he was an ultra dove. After that, ultra hawk. He's going to fight inflation. He's going to be the one that goes down in history as stamping out the current inflation. And it was not long after that, he did begin to increase interest rates. And there you go. I mean, literally the top of the bull market. So if you don't think this stuff is important for your portfolio, you're wrong. It is. Oh, my portfolio goes up because of X, Y, and Z. No. Your portfolio goes up because of what is happening with the price of money, because the price of money affects all assets. Price of money, of course, is your interest rate. And look, the worst is behind us, probably. We can see how the trends have turned through here. My traffic light system, pretty simple. Green is good. Be invested. Amber, not so sure. Better start to reduce my risk, not add any new trades. Pink is not good. Okay. And then it just reverses. It goes through the other phase. Amber is, I can start to add some risk. Maybe I shouldn't be short anymore. And then we're back to green. So that's the good news. We are still green. Nothing goes up in a straight line. We're going to have these pullbacks as we've seen over the last few weeks. We managed to catch this one quite early. In fact, on that day there, we were in session talking about the possibility of taking out some hedge positions. The goal of a hedge position, of course, is to not eliminate, but as much as you can mitigate downside risk. Precipitous fall with that ends in that white candle. How about that? Really, if you look at the close here, from this close here to this open here, that's a gap down. We actually gap down, and so often you're going to see downtrends terminate in such a way where you actually gap lower. Oh my God, it's the end of the world. And then at least the short-term traders are, oh my God, it's the end of the world. I have to unwind all of the risk that I've taken. This is it. This is the big one. I have to get out. But then the big money, and it happened a bit earlier than I expected, to be fair, but the big money is saying, no, we're going to buy the dip on this one, and boom, boom. That's a little bit of an interesting one. Gapped up, pulled back, volatility. Look at the volatility through here. Boom. This is positioning ahead of Jackson Hole. You try and find me another 2 of those candles for the rest of your life. You'll struggle. And then this is incredible as well. Just the amazing flip-flops we've had in supply and demand as evidence in these candles. And then from here, actually very steady. I mean, this is kind of the punctuation mark on this recovery. We have gone from lower points of supply. What does a point of supply look like? It looks like this. Let me change that. PO. Don't do that for me because I did it too late. But let's try again. POS. POS. There we go. That's red. Good. And there's one there. We're too zoomed in, so it'll be close, but may not be perfect each time. That is not because that's all one move. That's all one move. That's actually all one move. There you go. Oh, there you go. Point of supply, and you've got your point of demand through here. What does that look like? So it happened quite early actually for us this time, but let's see. Quite quickly this time also, but it just the size of the move was extreme. So you've got time and then you've got price. Something that happens quickly in time is good if it doesn't happen to a great deal in price. So that gives you the ability to get out without losing too much, or get back in without missing out too much. But when you have something that moves quickly in terms of time and huge in terms of price, that is problematic for your technical analyst, because even if you can react quickly, the problem is, how do you get back in at a nice level? And some of you should think about what I just said there, and it's probably hitting home to you. It's like, yeah, Carl, this switch, this was good. I managed to sort myself out here, but I haven't been able to really take advantage of the fact that, the price action did change quite quickly. I mean, as of this day here, and this is the important day, let me just label it with the number 1. So that candle where the 1 is the day that we confirm higher points of supply. And the reason why I put question marks on this point of supply is we don't know where the next point of supply is going to be. It won't occur. We have no idea. It could occur anywhere. Let me go escape there, and it could be maybe on that day that we have a lower high and a lower low to therefore confirm this eventual point of supply. But we don't know where it's going to be. But we do know 100% wherever it is, it's going to be higher than this one here. 100% it must be higher. So we don't have to see it to know it's going to occur, as long as the NASDAQ continues to trade between now and infinity. But we can say with absolute certainty the points of demand are higher. So there you go. This is the candle. Candle 1 confirms back to higher peaks and higher troughs, building demand, diminishing supply, buy the dip, and the candles are all good from here. So I'm going to declare that correction of late July, August over, and we'll see where we go from here. I can't see any reason why, from the candles, why we can't go back up and at least test those highs. Will we blast straight through those highs? Funnier things have happened, and don't put anything past the NASDAQ. But probably we'll see, actually, I've drawn these, we'll probably see this sort of stuff happen. And a little bit of a pullback. And then from there, what do we want to see? We want to see a test of, why do I always do that? A test of, it's that a test is coming. There it is. Something like that, where we create the higher point of demand just beneath the major point of supply, which is now 14.4. It's this one here, 14.447. See how the supply side responds, but more importantly, see how the demand side responds. The shallower that pullback, the better it will be. The better the candles that come in around here, the better it will be. And then probably we are going to move up to the next leg. Let's have a quick look at the weekly chart, see how that one's going, and that'll give us some idea of what the potential scope is. I like the weekly charts. It dies down a lot of noise, And you start to see that really all we did in that correction, as wild as it was for a short period of time, was come back and test the light green zone. How about that on the weekly chart? And the light green zone almost coincided there with the dark green zone, didn't it? Very similar. And it makes sense that they will. But note here just how reliable my model is. On the weekly chart, it dials down so much noise. You could just trade on weekly charts and check the market once a week. Check all your stocks, check all your positions on the weekend. The market's closed, you've got all the time in the world. And then put your orders in Monday morning and not check the market again until Friday night or Saturday morning. But again, look at the short-term trend, how well it supports the price. When you break beneath that, it's pretty much all over Red Rover now. Not the flippity flop that happens in the daily chart, but it's just so clean. It's so clean and so decisive. And the long-term trend is, well, let me make sure, do I really need to prove this to you? I know you believe me already. If you've been watching me for any length of time, you know just how good these are. Why are they so good? I'm sure you're wondering. Hey, I'm wondering too. I don't know why they're so good. They just are. You don't need to understand something to use it. Do you understand how the internal combustion engine works when you're driving to work in the morning? No, you have no idea how that bloody thing works. Do you understand what Wi-Fi? Do you understand Wi-Fi? Does anybody actually understand Wi-Fi? And yet you're using it. You're probably using it right now to listen to me. So that's where I think we are. I'm not going to say where I think we're going, as much as I've drawn all those things, because I don't know what's going to happen next. That's the other key message I need to put across today. Let's go even riskier, I reckon. The Russell 2000, riskier than the NASDAQ. And I always start looking at the riskier stuff, because if the riskier stuff is doing well, then all the other stuff should be fine as well. Not as good as the NASDAQ. Nowhere near as good as the NASDAQ. Look how much more severe this downturn was. Double bottom, decent hold here at 1830, decent candles off that. It's all decent sort of stuff, but nowhere near as strong. I mean, really at the end of the day, and let's go back to the weekly chart here, it's not until, again, you can see the deficiency here, can't you, between the NASDAQ and the Russell. If this is trading at 2050, ladies and gentlemen, then it's on. I mean, you know we're in a bull market. There will be no doubt about it. There will be no bear to find to ask about it, because they will be absolutely torched and swinging back onto the bull side. So really, this is one that we should keep an eye on, because this is corporate America right here, and if corporate America is firing as we get above there, then the bull market is well and truly upon us. I think that's enough for US indices, but let us stick to the weekly charts and have a look. Well, actually, I'm going to look at this one, the SKEW index. This is very interesting because, actually, I've got another chart here. Hold on. I'm going to find it. That's the one I wanted. So it's got the all the interesting stuff on it. I think I've got another one somewhere. Let me try this. No, it's not that one. Where is it? Maybe it was that one. I thought I had even more labels on it. I'm going to go everywhere and I'm still not going to find it. Not that one. Okay, let's stay here. I thought I did a few other. No. I'm intent on finding this, aren't I? I know I've got it. There it is. Told you. Okay, so this has got some labels here where the SKEW has spiked. And let's go here to auto. And you can see that 2 months prior to the 2018 bear market, Fed hikes versus slowing US economy, US-China trade war occurring in the Trump administration, the S&P 500 fell 20%. So this spike to 160 here on the SKEW occurred 2 months before a bear market. Here we've got one here where 2 months prior to the COVID bear market. Now, I get maybe fund managers might have been positioning ahead of a trade war and slowing economy. You can see that stuff happening. But ladies and gentlemen, how did they position themselves 2 months ahead of COVID? You might say, hey, the whole COVID, Carl, actually started in late 2021. Bunch of workers, wasn't it? A bunch of construction workers, and then maybe they knew. Maybe somebody knew about it. But anyway, it spiked to 150 pretty much out of nowhere. then bang, COVID, and then 5 months, this was a little early, I think, to maybe say there's something going on, but 5 months prior to the 2022 bear market there, spiked to 170. That's the biggest, I think, on record. So, yeah. So that's interesting. This is the start of the bear market. We've got a little bit of a spike, Fed lift off. We've got a little bit of a spike. And then we had this mysterious one, which I just label question mark, because we don't know yet what it means. Maybe that's proceeding by a few months now, sort of within the 5 month window of the 2022 version, the next big bear market that we don't know what the trigger is for that. But it did spike substantially. But it was very interesting to see, if we sort of compare that to this chart here, that I think it's a little bit different this time. Famous last words. And I just think as we're coming out of, again, 2-generational change in rates, I just felt that this was fund managers coming back in droves with some serious cash, but also protecting themselves. Because what we're looking at here with the SKEW is the volatility of those really far out put options. Those options you buy for a little bit of money that gives you protection against a really, really big, so greater than a 2 standard deviation move in the S&P 500 to the downside. So that this is your black swan event protection. So what we're actually seeing, I should have explained at the start, is markets anticipating black swan events. And the SKEW index has been pretty good at doing that in the past. What's this one about? Is this one anticipating another black swan event? Or I think this time around, it's after that big bear market we had, that it's fund managers getting back in, but taking that protection as a hedge, not necessarily people just shorting to try and take advantage of that. And then we see this big move back up in the SKEW this week. Look at that big move back up, big white candle in the SKEW corresponding to that white candle in the NASDAQ. So I see this as a positive. Some people are going to shout at me and say, no, Carl, this is actually what it means. And please do. I'd love to know your theory on it, because try and Google SKEW theories. There are very few consistently widely held theories about this. There's lots of different ones out there, and everybody's going to have one. So you've heard mine on the SKEW. The volatility is completely useless. The VIX is completely useless. Don't bother looking at the VIX. It is defunct. I said we were going to look at a few other weekly charts. I just want to get a feeling at the start of this presentation for what's going on around the world. Do investors feel like taking risk, or are they moving back into their shells? Look, prior to the last couple of months, they were looking to take some risk here in Europe. We're looking at European charts. Now, if we get this synchronized growth around the world, then that's good for us, with our little old Aussie portfolios back here. Can't hurt, can it? So I think that still looks very solid. That probably looks less solid. The DAX, there's some serious problems in the German economy at the moment. I mean, they are in a recession, no doubt about it. I mean, US is still growing at 2.5% per annum, right? Euro Stoxx 50, bit of everything, but mainly skewed to the DAX. That is the biggest market there by capitalisation. The FTSE, I'm going to say that actually doesn't look very good at all. I mean, I think this is kind of looking like it's going to roll over. A very similar market to us, a lot of big banks, a lot of big resource companies. That's interesting. Hey, bouncing off this level, don't get me wrong. Not going to roll over tonight, but that's not the best short-term trend. Long-term trend still up. We're in weekly charts, don't forget. Let's look at Spain. Spain probably looks the best of the lot there. Let's head over to Asia, ladies and gentlemen. Look at the Hang Seng index. That looks pretty ugly, doesn't it? We've had a little bit of a rally because we're hoping that, cuts to Chinese stamp duty and the various steps they've taken, minor steps that they've taken with their interest rates. Some of the bank deposits now that they're lowering the rate of interest you get as on your bank deposits in China, so you're more likely to want to go and invest that in the share market. They're trying to shore up their share market. Animal spirits, let's just stay in China. They're trying to get those animal spirits going in the share market, which has helped them before. I don't think it's going to help them that much this time around, though. I mean, that looks pretty ugly, doesn't it? It's slipping and sliding, isn't it, down through here. I'm so glad we're looking at weekly charts this week, because we are, I think, taking out a bunch of noise. I'm not so confident in China, ladies and gentlemen. Tell me if you are confident and why you're confident. But look at that. Even we got that big pop on the stamp duty news, fading fast now. Now, we're still waiting. Of course, today's only Thursday, so we still need a Thursday and a Friday candle in there. Anything can happen. But otherwise, the trends are still very much set to the downside. This is the Mainland real estate index. This is a meaningful bounce here. That was a stimulus-inspired one. Don't ask me which stimulus it was, but that was a stimulus-inspired pulling back. Look, that's still a big white candle, and we should pay that some respect. but still overall trends are down, and this one, looks pretty darn horrible. This is I've got a log chart going here as well. Isn't that neat? Let's bring it home, shall we, to Australia. ASX down on the weekly chart actually doesn't look too bad. You can see it's a bit footsie, isn't it? It's not NASDAQ. It's a bit footsie. It's not quite Russell. It's a bit footsie. FTSE 100 in the UK. I think it's okay. I'm very encouraged by today's candle, actually. I'd love more than anything to see this blast through the top of the range. But having looked at what we just looked at, what's going to be the catalyst to make that happen? We've still got big problems in China. Can our ties to the US, and when the America goes up, we kind of go up by default, is that enough to take us through the top of our range? Yeah, we've got a bit more of an active technology sector at the moment, but unfortunately, we're still beholden to this largely, aren't we? The materials sector, and that's going to move. Hey, it's nowhere near as bad as the China charts, to be fair, but more recently, I think there's quite a high correlation there. Hey, big week up this week, and then obviously the financial sector as well. Banks are starting to turn the corner. They're not looking too bad. And it's the peripheral stuff that could probably move. Technology, I think, still looks really good. So that's the Information Technology Index. I think that's what's fine. What else is looking good? Discretionary. That's a nice chart. That's a really good chart. A great test and hold of that long-term trend zone. Looking very dicey, but no, that's my favourite sector index right now. Energy looks okay. It's had a bit of a pullback last few weeks, but you can see the trends there are very sound. I think that's it. I mean, there's not a lot else that, from a technical perspective, could really do it. Some stuff looks really bad. Healthcare about to break down. Let's hope that doesn't happen. Property trusts have been in the toilet. Actually, that's starting to look half interesting, but Goodman Group is a big part of that recovery there, not representing the whole sector. Staples looks pretty ho-hum. I'm sure I'm going to get questions about a lot of these commodities. So let me go to you. I've talked long enough. I'd love to keep going, but I better do some of yours. Let us head over to the streamers to see what the streamers are talking about. Hi, Andy. MEI, I think, Andy, is a stock chart, and we do stock charts on Tuesday for Australia and on Friday for the USA. So unless that is a commodity, foreign exchange, crypto, indices, I'm going to pass on that one today. Kirsty saying, hey, Carl, is India developing? India is a developing nation, have you got any data on that market, i.e. bonds, currency, and housing? I don't follow it that closely, Kirsty. I do have the ability here to look at the Nifty50, I'm pretty sure. There it is there. I should have put that on. And I did get a question about Japan here. I'll do that second. There's your Nifty50. We are looking at a weekly chart, don't forget. But in terms of trends, ladies and gentlemen, this is the strongest trend out there. I don't think we have it on our platform, though. Who's here? Khan's here. Khan, I know that they took it off, didn't they? Did they put it back? Can we get it back? Khan's going to start talking to me pretty soon. Streamers won't hear it, but the Zoomers will hear it. Can't give me an update on the Nifty50. Yeah. Yeah, it's not just us. I think it's gone from many brokerage houses as well. Look, great trends. I think it's one you want to keep an eye on. Just pulling back a little bit here, but maybe we need to do a session on Indian stocks, ladies and gentlemen, sometime during the week. That could be interesting. But to answer your question, Kirsty, I don't have a lot of data on those. Adonis saying gold looks to be on a charge. I think gold is looking good. I'm not sure about a charge, Adonis. I think that's an exaggeration. But let's look at gold. I'm going to head, where am I going to go? I'm going to go here. So I've got my gold scratchings coming up for you. And that's all the way. Now, gold you absolutely can trade on our platform. Let's do a gold trade today. So I'm going to grab that. I'm going to zoom in. Really zoom normal. Yeah. Now, would I buy it? I think you can have some risk on this. I think you'd have like a 1/3. It's a punt. See how it goes. It's not a straight out screaming buy, but I think it deserves a little bit of risk here. I'm not. I'm not gushing about it clearly because I do think there are some problems. We can see the long-term trend has turned amber. That's not by accident. That's for good reason. And the short-term trend, which I probably can't select right now because this one's on top of it, doesn't matter, is not yet up. We are trying to hold a long-term trend zone. We did crack it a little bit. We've moved back above it pretty well. Nice candle here. Very, very nice candle here. Nice little lower shadow here. There is some demand in the system for gold, but clearly there's some supply. So I'm not too concerned about the demand I'm seeing, Adonis. I'm concerned about the supply I'm seeing. And there's always two parts to the equation. Don't focus so much on what's going on here. So try and cast your eye back and say, okay, well, what is the demand about to hit? And I think it's quite motivated. But I can see why you could have some risk on the table here. This is really, if you're trading this long, you're kind of at the same time trading this next chart short. And let me show you it in a second. Well, let's go here. We've got the US 10 years, which I know that looks pretty extreme, but don't worry, it's just a little quirk here. And I can fix that up by doing that. This is the US 10-year notes. So you can see how gold has got itself a little bit of a rally as the US 10s have pulled back by 25 basis points from near 440 down to 410. And if this was a stock chart, what would you do? And this is an important chart that you need to understand. Everybody needs to pay attention now, because if your portfolio is going to succeed, we need to see this come down. We don't want to see it come down too quickly either, because if it drops rapidly, it means we're in a recession, okay? And that's not a good thing either. So just a nice, gentle tapering off of this, even if it just went sideways at 4% for a period of time, is going to help that NASDAQ push up. Okay, it's going to help the Russell 2000 recover. It's going to help the ASX 200 and everything else that is a big ball of risk. It's going to help the bond, obviously bond market will recover as well. Okay, so this initially sharp move down has helped us, but we don't want to see it go down too quickly, because it is indicating a recession. Gold can rally when rates come down. In fact, what was gold want? That's what stocks want. Gold wants this to collapse, because if this collapses, then we're in the poop and yields are coming down, and that's a double whammy positive for gold. Okay, I'm not sure if that's going to happen. Just for your reference, again, that looks a bit wonky. Let's fix that up. Go off here and you do that. 30 years have come back substantially, but you can see overall why we got that July-August correction. Let's have a look at the real yields, which have eased back, because those 10-year inflation expectations are coming down substantially as well, sort of just under 2.3% now, and that's very close to the Fed's 2% level. And with yields coming back also, this has moved down, so that's helping gold. So we're seeing some help here, ladies and gentlemen. We identified these charts as the key risks to your portfolios, I don't know, a month ago or longer. In fact, we've been talking about yields for many, many months, but specifically real yields a few weeks back. So let's go back to gold very quickly and just say that these are the macro factors impacting the gold price, but from a technical perspective, I don't mind it, but as I said, not gushing about it. I think you can add some risk. Let's go to the platform anyway. It's probably, would I do this with my money? No, I wouldn't. So you can either tune out now, but I just want to go to the platform and I want to just put on a trade. How are we going on some of these trades? We're still doing well on a few of these other ones. I closed out the NASDAQ hedge deliberately. I did it during the week just to illustrate that I was watching it and I saw the candles and the change of price action, and they are all triggers to go minus 1/3. So that hedge is officially closed for all the reasons we talked about at the start. I'm not going to go into those trades right now unless somebody asks about them, and then we may come back and edit them. That's your business to ask me about them. But I do want to talk about gold. The way to find gold here is to go XAUUSD. Maybe we're not trading gold today, but I want to show it to you. The candles might get better. And I'll go back to the chart and I'll show you what I want to see to find the trade in a second. But this is just for your reference. If you do need to do the trade at some stage, this is how you do it. Now, can't go any lower than, always click on this. You always hear me clicking on that because I want to see what the smallest amount is that I can do on the ThinkMarkets platform. Then the next place I go is here, and it helps me understand that for every pip movement, I make or lose 15 cents Australian because my account's denominated in Australian dollars. And what is a pip? Well, the pip is the rightmost of the large numbers in the quote. So you see the quote here, we're quoting gold at $1,945.65 US. It's changing, and that's the offer there. I won't even say it because it's going to keep changing. Why is it changing? Because, hey, it's spot gold. It's always changing. The spread is 20 pips. So 20 times 15 cents, that's going to be 30 cents. It's going to be the cost to do this trade. Think about what brokerage is for shares or whatever else it is you're trading right now. This is going to cost you 30 cents to do, the minimum amount, I should say. we're going to need $150 in our account to do the trade. Now, I like to do 3 because that allows me to get in and out in thirds. Okay. If this is too much risk for you per pip or too much margin, then don't do 3. Do whatever suits you best. I don't click take profit. I don't do profit. I don't do profit targets. I get out when it's time to get out. But I do like to understand what my risk is going to be. And the way I do that is to grab this and start to pull it down. Because this, you notice that this is changing my stop loss. As I change this, the stop loss comes down. And visually, I don't set stops based upon a number or a percentage. That's silly. I set stops visually based upon where I'm seeing demand in the system to protect my trade. Because if the price comes back down again, we're looking for a point of demand. Demand is where the demand is going to come in and push that price back up and hopefully protect my stop loss. Okay. People make mistakes when they set stop losses and get stopped out too quickly because they put their stops in places that mean absolutely nothing to anybody. So it's great we've got this visual tool here. We grab the line, we go down. Clearly, I want to get beneath last night's candle low, but it's this candle here, this big white candle, lower shadow in here. You see the little congestion zone in here. I want to get beneath that. I think down there is probably okay. Obviously, the wider the stop, the more risk I'm taking. You can see I'm up to $162 now. That's Australian. Ideally, we're probably down here though. But you've got to think, if we get down here, how many exit signals we've probably had by then. But this is kind of your fail safe. Well, I don't want to lose more than a couple of $100 sort of level. Okay, so let me I'm not going to be up to massage to 200. I don't want to get too close to that. I want to be beneath that level. I want to be beneath a round number. I don't want to have my stop at 1900. That's just silly. And maybe I can even tuck it under there. So we're kind of looking at a 27.36 sort of risk on this one. If it's too much to you, again, tab this down, and you'll have to just be all in, all out on this trade, rather than the plus one, the thirds out. Okay, so I think that's it. I mean, if it's too much risk, do less. This trade is set to go. I can't see any reason why or what else I need to do here. I'm pretty fine. We just go confirm buy and then place the order. You won't hear the chime, but it'll give me an audio confirmation, as well as it's saying here the position's created, and therefore it will now start to appear down here. XAUUSD, we've got the trade going. We're going to lose money at the start. That's it was what was it, 20 or 30 cents for one contract. So obviously it's 90 cents for the 3 contracts, which is about your dollar there. Okay. Now you need to stop looking at that. Don't look at that number, ladies and gentlemen. Don't look at any of these numbers, because you'll become hypnotized. Okay, you'll be in a hypnotized state, and in that hypnotized state, you're going to do stupid things to your trades. Okay, so set up your trades, turn this damn thing off, and go do something more productive with your time. I did say that's just a case study. It's just an example. Not ready to do gold yet. Look, I want to see a little bit of a test and hold here. If we see some really, really strong white candles, really big candles, white candles, lower shadows coming in around here, I think that's the one you want to look for. I know I've stuffed that up, but I'm gonna make it work in a second. Let's do that. There we go. That's what we want to see, in and around there, lower shadow, and then I think you can start to pop that trade in as the first 1/3 of this next thing. Where's it going to end? I don't know. This could be the beginning of the next big run for gold. Let us head to the weekly chart and see what it looks like there, and that might give us some perspective on where gold could go. Again, you can see some of the caution that I've got here. Is this the next big move up for gold that takes it through that high? It's not impossible, given that we are very much, this is very much a long-term uptrend here in gold. Okay, so it is possible, but you can see what I mean by popping up, pulling back a bit, holding that level, and then you start to build this inverted head and shoulders. And then I think gold's really setting up not quite nicely to finally crack through. You can think about this big point of supply, how massive it is at 2073. We've had a big test here, but a big test here. 1, 2, I'm not trying to be flippant here, but third time is often a charm in the markets, because you've weakened that area of supply each time you've been up there. Let us head over to, I just need to do Japan, because Barry has asked for it here, and then we're going to do copper next. So hang on for that one. And then let's do some lithium, let's do some uranium after that. So I'm sure we've got plenty of interest in those commodities, but I'm just trying to find Japan here. There it is, N225. Let's stay on the weekly chart. Look, that's a really strong chart, isn't it? We've got that pullback, we've got that reaction to this crazy straight line move up. And I think funds are starting to buy this dip here. That short-term trend zone should support, it hasn't always in the past, to be fair, but let us see. I mean, the next big white candle, high close, I think you can add some risk here on the next move up, because this is ultimately This is a massive, massive breakout here for the Nikkei. I mean, this is generational sort of stuff. So yeah, I think keep an eye on that. There could well be a trade there. I don't think the trade's there today, but you might find a finer, a more pinpointed entry in the daily chart. Let's have a quick look. But it's certainly one I want to keep an eye on, Barry. Let's go here. Yeah, see, there's nothing in that daily chart just yet, is there? Okay, the question was about copper from Nick. Let's go have a look at that one for you. Got a couple of ways to slice and dice this one. Make sure I've got my latest data because London Metals Exchange data comes in quite late. Over here, copper, let's make sure we've got the last bit there. And 30 we do. So this is the latest price, and it doesn't look like much because we only get a PM fix from the London Metals Exchange. So I have to do a line chart. Looks okay, not great. We've still got a very clear-cut long-term downtrend. The short-term trend is amber, you can see there, but it was recently down. This last little low here, which I haven't yet labeled, but will do now by doing this. All of my labels, all of my stuff on my charts are manual. Can you imagine how much work it takes to keep all of this stuff labeled? 81.26 is that low there. You can see the fact that took out 81.65 is not a great sign. Straight through 83.54, 81.65. This is not great price action at all. And 8400, 8500 probably going to resist price action there with the long-term trend zone. Look, above that, 86s, 87s, I think it could look really good, but I'm not that bullish about copper just yet. It's stuck in the middle. I'm not going to say I'm overly bearish either. I'm not trying to be flippant here, but how do you decisively say what's going to happen when the trends look like that? You can't. It's impossible. It's not just me. The market can't figure it out. That's high-grade copper. I know I'm jumping around here, but I've got my scratchings at all different templates on this charting platform, and it is going to appear when I figure out where it is. High-grade copper, just in case you want to look at the contract in New York. They must have done a rollover on me because now all my levels have changed. So when the contract rolls over, I've got to fix them all up again. Happy days for me. Very flat, no view on that. Let's look at iron ore because we're here. I think that looks pretty darn strong, doesn't it? I mean, let's have a look at the weekly chart. Not bad. It's vibrating in a range, but this trough here, that trough there, it's high points of demand breaking through this little consolidation range. No reason why it can't go up and see 900. Why is it going up? I don't know. Nobody knows. Nobody knows why iron ore is going up. If you know, let me know. That's the one in the US dollars there, but it looks much better in Shanghai. It is a China-centric commodity for obvious reasons. Let's look at nickel while we're here. Let's head back to this one and go here, nickel. That looks horrendous, doesn't it? That just looks terrible. And, China stimulus be damned. It's one of the worst charts in global macro, surely. Where's your big China stimulus rally there? Where's the long-lasting impact? Look, while we're here, looks at the base metals. Aluminium actually trying to start to rally. I mean, still awful, but trying to start to rally. We're trying to understand what's going on with global growth. Lead's actually not bad. That's lead. South 32, that thing's been smashed. Goes to show you can't go, that commodity's going up, I better buy that commodity stock, because commodity stocks aren't the commodity. They've got all sorts of problems and issues they have to deal with, and there's every chance that you buy your commodity stock, it goes down and your commodity's going up. You have to find a way to trade the commodity itself. We don't have a lead contract. I don't know anybody that does. Tin looks awful. Zinc looks okay, a bit like aluminium, trying to bounce off those lows. Let's head over here and look at the lithium charts. And we're going to start off with lithium carbonate, which you can see is heading down there every day. It's so rare to see any commodity move so consistently in one direction or the other. They're either buying the hell out of this or they're selling the hell out of it, and they are selling the hell out of this right now. 165,500 is the key level. We need to see a bounce. Not there, above there would be better, and you want to see a real V-shaped bounce. You want to see obviously it stop going down, but you want to see it start to print big gains very quickly, and that will create that FOMO, that fear of missing out. Confirm 165.5 as a low. rising demand of the system, and then the supply will probably back off, and you can see this thing start to appreciate, or at the very worst case, at least go sideways. And sideways is still fine for a lot of our lithium producers because they've got really low cost base. They're printing money even up here. It's just this was not what this. It's not so much that this is wrong. This bit was wrong. Okay, this bit is just trying to fix up how wrong this bit was. Okay, this is what happens when you have this huge, exacerbated by COVID, this huge supply shortage, big explosion of demand, and you have this premium associated with this commodity. Which, if you're somebody making electric vehicle batteries, I need that certainty. I will pay anything to get the certainty. Then supply starts to come on stream, and whatever the supply chain shortages that were causing this outrageous rise start to ease off. And it's just I'm not scared. I still need a lot of this stuff. I know I need a lot of it. I know, bottom left, top right charts for EV demand. Geez, how many times have you seen those? But I'm not panicking anymore. I know the supply is there. I know and there's more coming. I'll be fine. Okay. Look, maybe in 6 years' time, I might be in a position where I'm, the market's in shortage, but right now it's okay. I don't have to panic. Here I'm panicking. I'm scared. Here I'm okay. And that premium has to come out. Where could this go? Look where it was before that. Look, I don't know. We could see, 2/3, 75, 85% of this high knocked off before we get to a place where this can really set a really good base pattern. It could be years of basing out sub 200, I don't know, 100 to 200 before you start to get that long-term stuff starting to move in. I don't think people who are lithium bulls really understand that's how markets work. Go back to tulips and have a look at that chart. But Carl, okay, maybe you're right, maybe I'm wrong. I'm not a lithium bear. I don't care. I prognosticated way too much. I'm just going to go by the trends in the charts. The trends in the charts are pretty clear-cut down. Hey, if this starts going back up again, I'll be the biggest lithium bull you ever met. So obviously we've got lithium carbonate. You can refine that into lithium hydroxide on screen. These are your battery grade products. See up the top there, battery grade. And this is not battery grade. This is stuff you pull out of the ground. Okay, and then you need to refine this into your lithium or your battery materials, but typically you're turning this to lithium hydroxide. And where's your bottom on that one? I mean, that's just going down every day as well. Stuff that happens in China always doesn't make sense, everybody. Uranium, we have to talk about uranium today. This is my favorite chart of the week is uranium. I probably shouldn't build it up because we're going to be disappointed by this one, okay? Without a doubt, this is going to end in tears and disappointment. But I did tweet this today. It's getting close to 60. One of the big uranium bulls I follow said it was above 60. It might be the case. I mean, this is a front month contract, maybe one of the other further out contracts printed above 60, but I don't have that just yet on the one I watched. I'm not saying his price is wrong. He's seen it. It's happened, but it might be on one of those further out contracts and this one tracks. So if you're wondering why, if you follow that person as well, then you might be wondering why that said 60 to 75. I think it was, and this one isn't saying 60 yet. That's all it is. It's just a mismatch in the contracts. The shape of the chart is more important than the actual price. That's always the case. And if we go to the weekly, you can see the next big level isn't out here until $72. Okay, after this breakout, that is clear-cut technical analysis 101. Does it mean we're going to get there? No, it means nothing. It's absolutely meaningless. The fact that the last peak back in 2011 was at 71.90, wherever it was, $72, is completely irrelevant. There's nothing in the universe that guarantees we're going to get there. It's not how the universe works. But hey, the chart's going up. The trend looks pretty darn good. Silver for Alan. Need to do that one. I'm getting to you, Perry. I'm going to get to Forex soon. Let me just do all these commodities first. Silver on screen. It's a higher beta play than gold in many ways. That chart doesn't look bad. We're on the weekly chart here. We're going to go to the daily in a second. It's got a holding, that long-term trend zone. It's pushing back up. Little, higher troughs here. It's not something I would look at and say, oh, I can't buy that if the daily chart did everything I needed to do. Let's have a look at what that daily chart looks like now. And it's this one here. I go here, it's got my scratchings. Go auto. It's like gold. I think it looks very prospective, but it's not yet something that I am confident enough in buying just yet, because it's not, the demand side is not the issue here. Don't get me wrong, it's the supply side that I'm worried about. Okay, let me restate that. Let me say it again, because this is, I think, what's going on with gold and silver right now. The demand side, look at this, Jason, this is what I have to deal with. when I try and keep these charts up to date for you. The demand side is not the issue. I can see it. It's clearly there. I'm worried about the supply side. Okay, we need both of them to fire for us. Happy holder on silver. Not adding positions to this just yet. Next little flick back. I don't need it to break out. I'm not going to wait till it breaks out. I just want to see. Oh, I'm drawing white. I can't believe it. And at least I'm drawing a white. I just want to see. Got those things there. Let's delete those. Just even the next one with some nice white candles, and I could do it because I've seen the demand come in. I just need to see how the supply responds. Okay. All right. I'm going to make sure I've done all the questions here. Khan saying you now have access to over 8,000 global markets, including indices, foreign exchange, metals, commodities, shares, crypto, CFDs on our platform. Thanks, Khan. Hi, Carl. I check Apple and Microsoft regarding NQ as they make up 25% of it. Yeah, fair enough. That makes sense. I do want to show you. This is why I was late starting today. Perry, I'm coming. Now, this is why I was late starting. So let's go here. I wanted to show you this. I was compiling this data. I do it at the end of the month for obvious reasons. But this is the All Ords total return index seasonality chart for all the data I have, and that goes back to 1982. That's a pretty decent whack of data. And we can see how the All Ords total return, now this is adding back dividends. There's no point looking at seasonal data. It's all over the internet, seasonal data, and everybody thinks they're so clever. Oh, this month isn't good, or this month is great. You know what? It's all BS unless you add back the dividends. Less important for the US, less of a dividend paying country. Hugely important here. You have to look at Aussie data with dividends added back in. And I'm the only one that has this data, ladies and gentlemen. You won't find it anywhere else in the universe. Only I have it. And we can see here, August is actually a good month for the market. It's the reporting season, typically. Companies report good earnings and grow earnings over a long period of time. It hasn't been all that good this month, but last little rally means it's not all that bad either. September is not a great month for us, and that is going back 40 years. But when you go to the this one here, which is not working, and I'm not sure why. You can see me clicking on the tabs. Hello. We got no response. Let's try that. It's not changing. Let me try and wake it up. No. Wow. Unless, look, I've just put the same thing in twice. Okay, that's where we're going to go next with the S&P 500. Yes, it's not changing because it's the same thing. Let's go here. This is what I meant to show you. Okay. The multi. So what we've got here is the All Ords total return again, seasonality, but over different timeframes. Because sometimes if your data sample's too big, you can have a lot of influence from stuff that happened, 30 years ago that isn't happening now. So you want to be able to look at different time frames and say, well, what's the recent trend? I get the big trend, but what's the recent trend? This is what this does here. Again, you won't find this anywhere else. I'm the only one that has it. But we can see here, August, less better over 30 years. We're going from just over 40 years to 30. September is a clear loser now. We go to 20 years. May, June starts to be a problem. We certainly felt it's always May, June's always a problem, but we really felt that this year. And then September again is a big loser. A loser, I should say. The big loser comes over 10 years, and then 5 years. September is rubbish, ladies and gentlemen, and that's where we're headed. So all that stuff I said at the start about maybe the NASDAQ's heading back into a new bull market, maybe that goes out the window. This is what it looks like for the USA. Again, so much data out there, but it doesn't have dividends. This is total return. I've added back dividends, and you can see there what we've felt in August, September over 30 years. That's as far back as my sample goes. And then August actually not too bad over 20 years, 10 years and 5 years. August, I think, had a bad rap. And again, a lot of people get up there and they talk about stuff they've read on the internet one time and they want to sound like an expert in the media. But unless you do the research, you shouldn't be saying anything at all. September over 5 years, really bad in the US as well. Let's go to Genevieve saying, hi, Carl. After declaring the death of gold last week, are you still of that opinion? I did not declare the death of gold last week, did I? I don't think I did. I'm pretty sure I didn't. I'll have to go check the tape. I've given you my comments on gold, Genevieve. Jill, and that can happen. Hey, something might look bad one week on the chart and then turn around. I don't know what's going to happen next. Oil from Jill. Let's go here. How are we going for time? Okay, I bet I need to pick up the pace. I'm going to go back here and here, and we're going to go to West Texas crude oil, which is in my energy section. Now let's go here because I've got scratchings here, and there's my energy. Let's look at coal. Let's look at coal. Jill, let's do an energy sector review, and coking coal continuing to rally. Hopefully, you can see the dots just here. I won't change the line chart because I won't need it in a second. But so we saw iron ore prices heading up for an unknown reason. Well, coking coal prices, your metallurgical coal, also heading up. Interesting to see nickel so bearish, because nickel's the other thing you need, of course, with your coking coal and your iron ore to make your steel. What's going on there? Thermal coal started to look good. It's still okay. I don't think we are not going to see this move. We're not going to see this huge move again. At best, if this thing nudges its way, crawls its way back to 180, that's magic for Aussie coal companies, because I was thinking it was going to go back to 100. So that is still printing cash, massive dividends. We don't need this to go up. Okay, you just need this not to go down, and that's fine for coal. Natural gas, this is the US contract just popping back up there. Did I say I wasn't going to go to line charts? Yeah, I don't know. This is a null and void. The European gas futures have pulled back. Brent crude looks okay. Jill, I think, looks okay. I'm going to go okay, not great. West Texas probably looks the better of the two. It's strong. It's holding the short-term uptrend. The long-term trend is trying to turn there, not confirmed yet, but it looks quite solid. I don't think this is going to explode anytime soon. No puns about energy commodities intended, but I think it looks very, very solid to maintain a modest short-term uptrend, and that there's no red flags here for our energy stocks in our portfolios. There's no real trade there if you want to trade oil, because you can trade oil with us as well. I'm pretty sure I've got no choice now but to go back to the foreign exchange, which is where we're heading next. Now, Perry's saying, Carl, in relation to Cboe SKEW index, there was also two spikes, July 2020 and 2021. Let's check that out. Let's go back to the SKEW index. Do you remember which chart I had it on, ladies and gentlemen? Let's go to SKEW. Here we go, SKEW. Wasn't that one. Wasn't that one. Oh, no, it's not that. I'm looking at the right one. Anyway, let's go back to the one we had. Let's just go here and zoom out. Line chart. I'll never find that one again with all the annotations. 2020, July 2020, over here. A little bit of a spike in here. There was. That's just as we're coming out of the pandemic, possibly as fund managers are looking to buy. Oh, that's February, sorry. There's July there, yeah. Possibly as fund managers are looking to buy back in and looking to hedge themselves because we just didn't know what was going to happen in that pandemic. That's possible. And 2021, just in here, I'm not sure what that might be. But yeah, I mean, they are fairly minor. I don't know. They're modest. You know, it's the big ones up here. They're important, and certainly that one there. But no, I take your point. Nothing really happened, is what Perry's saying. It's easy to make labels in hindsight. Well, you can only make labels in hindsight, can't you? Is it a predictive tool? I don't know. I'm not here to say it was. But I think now the movements are indicative of sensible risk management by fund managers who want to be invested. That's what I'm saying. Barry's saying, no, I did not say that. I did not call the death of gold last week. Okay, let us head to the foreign exchange now. And we're going to foreign exchange the hell out of the last 10 minutes of this presentation. Don't worry. Okay, so we're going to go to the first one here, which is EURJPY, which is this one here. And it looks great. Looks amazing. 10 out of 10 technicals here. I cannot fault it. It's so good. And we're going to find probably also that the GBP, JPY looks very good. Not as good. I think Euro's the one. It's funny, they flip sometimes. Sometimes it's the pound that is powering, and then it might be the euro. The euro's got the wood on the pound at the moment, certainly if you're looking at the various crosses. I wanted to see how that one's going. That is bouncing. I put an article out during the week. I do Forex articles for ThinkMarkets as well. Keep an eye on the market analysis page, and I put that out as a cheeky long actually, and that is just bouncing off that long-term trend zone, and it has actually done that. But I did notice frustratingly that the euro was versus USD was the one that had the stronger reaction there. Yeah, I'm happy to be in euro longs, and I think the yen is the best one to do it against Perry. Absolutely. Let's have a look at the Swiss. Haven't looked at that for a while. You can see we've still got that trade that's kind of slowing down a little bit, but still a very valid trade. Let us go to here. And I'm pretty sure we have EUR. Oh, we don't have it. There you go. I was looking down here. EUR JPY. We've got GBP JPY, which is actually losing at the moment, and we've got CHF JPY, but we don't have now. Again, I'm not trying to show you a balanced portfolio here. Okay, the results here are irrelevant because they're not being managed as trades. Okay, profit or loss is relevant. These are just case studies for us to muck around with and learn how to use the platform. But what I want to do here is go to EUR JPY. I think this is a trade. This is something, me personally, I would be happy to add some risk to right now. It's pulling back. That's fine. That's today's candle. Today's candle is irrelevant. All I care about is making my decision based on yesterday's candle, and this is just giving me a slightly better entry price. Okay. So again, make sure that's the smallest. Help me understand what my risk is, but I'm going to tick, tick, tick here because I like to do things in threes just for these case studies, so I can exit in thirds if it comes up again in another week. Click the stop loss button there. We are definitely going long. If we're going short, we'd have to click that button. Okay, I can see now my risk at the stop loss will change as I move this slider. I think that's as close as you could possibly go. So for people that want a really close stop, but probably all the way down here, which is frustrating because that feels like a long, long way away. It does mean my risk, well, it's not that bad, $84. I think I can risk $84. I need to make sure I'm, sufficiently beneath that level, and maybe that's giving me enough comfort down there. So 156, say. 47, and that's going to give me $92. So if I'm comfortable risking about $100 on the trade, if it goes poorly for me, I'll have other signals to get me out before, probably not guaranteed, but probably before I lose $100 on this. If $100 is too much for you to risk, then take this down. You could do this trade with as little as $30. Okay, I'm going to go with the 3. Notice how much money I need in my account to do this trade, and $168 in my account to do this trade. That's not profit and loss. I get that back at the end of the trade, whether it's a win or a loss. Obviously, my account will be debited or credited with the profit. The profit is separate from your margin. I can't see anything else I need to do here. I'm really happy with that. I don't do targets, you know that. So let us go with confirm buy, place order, and it will appear in the down the bottom of the screen here. In a second, there we go, refresh, and depends on where it puts it. EUR JPY buy. And there are the details. And you can see it cost me all of about 30 cents to do that trade. Now we need to stop looking at it because we will become obsessed with that if we spend too much time here. GBP JPY for Craig. We did touch upon that, but let's go back and have a look at that in more detail now. GBP JPY. Is it the lesser of the two? No, I don't think so. I think I'm pretty happy with that. It must have been one we put on here, I'd say. So that's why it's a little bit down, but I can see a signal to add to this trade here. So I could go another 1/3. So let me just pop that in just again so we can track it forward. I need to go back here and get the right security, GBP JPY, and I'm going to add another 30. I'm not going to do 3. I'm just adding another unit. I'll leave the risk management to you. I'm just going to put 1 on there. Let's go stop loss. Where should this stop loss go? Down here, I think is a really sensible place to put it. Let's not go right there. Let's go 182.87, $30 risk. And let us go place the buy on that one and place order. And that one's going to go in. We can track that one going forward as well. Which we already had that. Sorry. Jumping around, trying to get to the end of this. We are done for time here. So let us. I think I've got everybody's questions answered, though. To be fair, so let us head back to the presentation and say, for the person that asked me about the Aussie stock, tune in Tuesdays at 1 p.m. ASX edition, or tomorrow at 1:30 p.m. Note the slight time change for the USA edition where we do US stocks. www.thinkmarkets.com/au/webinars to register. If you're not a client of ThinkMarkets, you should be. We just spent an hour talking about all the weird and wonderful things you could trade with us. And hopefully you saw, as I placed those trades, not any harder to trade the sterling versus the yen or gold than trading whatever favorite little mining company you're trading right now. And why would you just limit yourself to trading a bunch of mining companies in Australia where you have that huge world of opportunity? And I talked about this idea with South 32 where the actual commodity is going up, yet the stock's getting belted. If you think a commodity is going up and you can trade that commodity directly, hey, why wouldn't you trade the commodity directly and get away from all the vagaries of what a stock price is going to do? Hey, if you do want to trade little mining companies with us, you can do it $8 flat rate, hidden share sponsored. You might be on a cheaper rate, but it won't be hidden share sponsored, and you have to be the beneficial owner of your shares. It's really important. We've talked ad nauseum about how good we are with our CFD offering, so I'll skip past that. But we are an award-winning broker. The platform, as you saw, very easy to use. You do get a dedicated account manager with 24/7 customer support. You can call us anytime. Our phone number's on our website, thinkmarkets.com/AU for details. I'm pretty sure Khan has already put a link. He has indeed. If you're watching me on the Zoom session, you can click on that link and open a demo account, and you're going to get some pretend money. You can do all that practice training, become familiar with the platform, comfortable with the platform before you start putting real money on the line. If you're watching me on any of the streaming services, hit the subscribe button to stay notified. I do go live a few times a week, and make sure you get that notification to catch either the live session or the recording that goes up to YouTube afterwards. If you like what I'm doing, hit the thumbs up button. Really important. Lets the management over here at ThinkMarkets know that I'm doing a great job, and they'll help me continue to do it for you in the future. Apart from that, it's been a pleasure chatting with you today. Hopefully you got lots out of it. I had lots of fun. All the best for your trading until we catch up again. Bye-bye for now. Before you run away, don't forget that everything we've discussed today is general in nature, has not taken into account your personal financial circumstances or particular needs. So before making an investing decision based upon this general advice, consider it carefully or seek the help of a financial professional. You should read the rest of this disclaimer because it's important. And if you have any questions at all, head to our website, download our product disclosure statement or our financial services guide, or of course, give us a call. Bye-bye. Hi there. It's the stream, different view. Yeah, the stream was a bit the stream was a bit slow, so I have to let the stream get to its conclusion before I stop the stream, and that way I get the full video on YouTube.